Many people have been left scratching their heads trying to understand why mortgage rates have gone up, even though the Fed has cut theirs. Hey, gang, I hope this video is finding you well. I think we've conditioned ourselves to believe that the Fed is more interested in mortgage rates than they really truly are, and that the Fed really has a say in mortgage rates more than they truly do. Now, I don't want to sit here and say the feds have no influence at all. They do have influence. But for a lot of us out there, I'm hearing a lot of talk that's giving the Fed a lot more credit than they should get for how mortgage rates are moving. So if you're a professional, real estate professional, mortgage professional, or if you're just a consumer, like a homeowner or somebody that's looking to get into home ownership, I want to kind of clarify what is happening with mortgage rates and why they are moving the way they're moving. Because the Fed just cut their rate, and yet for some whatever reason, rates are up a half a point over where they were just a few weeks ago. So I want to give you some commentary and a little bit of an explanation as to why that is happening. But first, I want to give you just kind of introduce you to a new party to the conversation. Right, we already started off talking about the Fed, and we know what the Fed's been doing. They're trying to fight inflation. They're trying to do that by slowing the economy down with a higher Fed funds rate, which makes it more expensive to borrow money. Right. So the Fed is concerned about the health of the economy. The other party I want to bring into this conversation is Wall Street, or some places, like if you are a mortgage professional, you may refer to them as investors, right? If any real estate professionals out there talk to economists or mortgage professionals, you may hear us say investors a lot. What we really mean is Wall Street, the group, the entity that buys bonds and stocks. And they have a big influence on mortgage rates. So what when you look at both of these entities, they are very interested and invested in economic data, looking at job reports, looking at inflation data, looking at the cost of manufacturing. There's so many data points that come out. They both are looking at them, trying to figure out the health of the economy. The Fed's trying to figure out how do they need a position in protecting the economy, and the in Wall Street is looking how to position on how they can make more money and protect their investments. So what I've put together, a few images, few charts showing you how mortgage rates move and really the relationship with the Fed to mortgage rates and how Wall Street affects mortgage rates. Let's dive in and take a look. So here's an illustration of how mortgage rates actually are determined and how they move. Look at the bottom blue line, the dark blue line. That is the 10-year treasury yield. That is the baseline for how mortgage rates are determined in a very loose way. Okay, it's a little bit deeper than that, but kind of just in a very basic way, you can follow and track how mortgage rates move by following the 10-year treasury yield. Why would we look at that? Well, first off, the treasury bonds are the safest form of investment out there. Why? Because the United States government does not default on their loans. When you buy a bond, you are loaning the money, you're loaning money to the government, right? So now they owe you money. And the government's never defaulted. So it's the safest form of investment out there. And the reason why we look at the 10-year is because the average lifespan of a mortgage is about 7 to 10 years. People typically end up selling their house. That pays off the mortgage. They end up refinancing to a lower rate or whatever reason they may refinance, which pays off that mortgage. They may default and foreclose on their house, which guess what? The mortgage goes down the tubes. So on average, the lifespan of a mortgage is somewhere between 7 to 10 years, which Wall Street looks at and says, you know what, we will base off of the 10-year treasury yield. The top blue line is going to be your mortgage rate. Why is that mortgage rate line so much higher? Well, in between, what they call that a spread. I like to call it a risk spread premium, which is risk, right? We're layering in risk, potential cost of loss, right? I mentioned foreclosures, I mentioned refinances, I mentioned the sale of a house, which pays off the mortgage, which could potentially That investment that a investor purchased, in this case, what we call a mortgage bond, which would be that light blue line, if it gets paid off in 3 years, well, they're not getting the money that they thought they were going to get, assuming that it was going to be around a lot longer. So, how do you make up for that? You have a higher interest rate. So, for accounting for people's credit scores, accounting for the amount of money put down, accounting for the cost of servicing the mortgage, that requires a higher interest rate. So that's why you see a higher rate on the mortgage. But if you look at both lines, you'll notice that they mirror each other very well. I'm going to introduce another line to you. It's the Fed fund rate. Check it out. It's gray. It's about as exciting as they are. The Fed fund rate has not changed up all year up until September. So it was at 5.25 to 5.5 all year long, stayed the same. Right off the bat, I think everybody can see that mortgage rates and the 10-year treasury yield did not stay flat, right? So it's because that's one of the first observations I would make in just saying that what the Fed does, there's not a direct correlation, because if there was a absolute direct correlation, that 10-year treasury yield line, that dark blue line, would also be flat. But it's not. And the reason why it's not is because Wall Street affects it. So I want to show you a couple of lines. I don't want to get super crazy here. I've probably already gone way past normal into crazy mode. But I'm going to show you back in August. I'm just going to point out a dip, right? When rates dropped back in August, we dropped from high sevens. We broke under 6.5 for the first time in a long time, since the very beginning of the year. And that was due to lower earnings reported, less than expected job growth. So we had people making less money. We had job growth not as high as expected, and we had higher than expected unemployment. And then throw it into the mix, we also saw some trouble in global markets. And that caused a big buy in bonds. What I mean by that is literally investors started buying bonds. And when investors buy bonds, the rate goes down. And it applies for mortgage bonds as well. Mortgage bonds are still relatively safe investments, they're just not high yield, meaning they don't have a great return on investment because, as the saying goes, low risk, low reward, high risk, high reward. These are low risk investments, so the low risk reward. But as the purchases increased, as investors were buying bonds, the rates went down. That's why we saw mortgage rates go down. And then all of a sudden, it jumped back up because we had a couple of reports that weren't in our favor, because Wall Street started selling mortgage bonds. All the while, the Fed fund rate had not changed. So right there, again, we can see that the Fed had zero effect on how the rate was moving. Now I want to talk about a little bit of a bigger picture, because this was a very tight window I was just talking about. Now I'm going to do two green arrows coming down. And we can see from July going through September, you can see kind of that steadily decline. We had the ups, we had the downs, but overall, during those few months, we saw rates actually go down. Why did we go see that go down? Well, it was due to a lot lower than expectations on whether it's going to be not on inflation. Inflation was pretty flat there, but it could be lower than expectations on unemployment, right? It could be lower than expectations on job growth. So we saw over a few months' time how the how bond market was riding these reports to lower rates, meaning Wall Street was seeing cracks in the economy. They were seeing issues that were leading to where the Fed may start cutting the rate. Ah, that's where the Fed comes into play. How the Fed is playing with the money of the investors. Again, not directly, indirectly. And so Wall Street's trying to get ahead of what the Fed wants to do. If Wall Street can get ahead of what the Fed is doing, if Wall Street can make the decision that the Fed is going to cut rates before they do, that means as an investor, you can make money if you are the first one to make the move, and you were right. You can make money. So that's why we saw the rates moving down. You see the green arrow, and you can see why those rates are moving down. The next question is, Why did the rates move up after the rate cut happened? Very simply put, was after the rate cut happened, Wall Street was trying to figure out what was going to happen next. Okay, cool. The rate cut happened as expected. What's going to happen next? We didn't have any reports that were crazy. Everything was just kind of mediocre. Nothing that really swayed action to buy or sell on the bond market until last Friday, when we saw a significant decrease in unemployment and a huge increase in employment numbers on the same day. And that's why we saw rates jump up. So, in a very small sample size, really without really going too crazy throughout the whole year, very clearly we can see that rates are dictated by Wall Street in their perception of our economic outlook, which then will tell us, give them an idea of what the Fed is going to do in over the next few months, maybe over the next year. And when we talk about how rates are moving, it's all about what's happening in the economy, what Wall Street thinks is going to happen, not what the Fed is necessarily going to go do. So, what I mean by that again is Wall Street was anticipating rate cuts to happen. We already started seeing rates fall because of that. Rates did not continue to fall after the rate cut happened, right? The rate cut wasn't the go signal of, okay, you can start lowering rates, right? All it was confirmation that Wall Street was right. Wall Street had already moved on after the Fed cut the rate. So moving forward, when we're talking about how this works, the best explanation that I can have is this: correlation does not mean causation. Okay. Meaning, for example, if we see a rise in ice cream sales and we see a rise in pool accidents, you probably would not say to me, well, Brian, we're seeing more pool accidents because of ice cream sales. You're most likely going to say, well, we're seeing more pool accidents because more people are going to the pool, assuming ice cream sales went up because it's probably middle of summer, it's hot outside, and people want to go do something to cool off, right? And very similar when we talk about the Fed and we talk about Wall Street, it's not a causation, right? The Fed isn't causing Wall Street to make a move, and Wall Street isn't causing the Fed to make a move. But there are correlations to how these decisions are being made, and that is the economy. Those are the economic reports that come out, right? And those in tandem affect how mortgage rates move. So, real estate professionals, when you talk to your clients, or even mortgage lenders, when you talk to your clients, we need to explain it as best as possible. I like saying correlation is not causation. Yes, Fed fund rate does have an effect on what's going on, right? And what the Fed thinks they're going to do is important, or what Wall Street thinks the Fed is going to do is important. But we need to understand what are the factors that are being looked at. And right now, it's employment. What does employment look like? And inflation is still important, but right now employment's taken over, and all eyes are on employment data. If we start to see employment, like for example, unemployment tick up again and keep going up, there's a really good chance we'll see more rate cuts, more drastic rate cuts coming up in the future. But if it's going to be gradual, that means this will be stretched out over a longer period of time. So paying attention to the data that really matters can help you figure out, will we see rate cuts sooner or will we see them later? Will we see mortgage rates fall sooner or will we see mortgage rates fall later? So, again, the Fed does not have direct impact on mortgage rates, right? Correlation does not mean causation. All right, guys, if you have any questions, let me know. Would love to see some dialogue. Would love to hear your feedback. And I'm always open to text, phone call, email. And if I don't hear from you, hope you have a wonderful week. Stay safe out there.